This video is not about frugality. It is about destruction, slow, silent, self-inflicted destruction. Most people confuse thrift with strategy. They are not the same thing. One builds wealth, one quietly buries it. 7 areas exist where being cheap is not saving money. It is lighting your financial future on fire and smiling while it burns. Most people believe frugality is a virtue. They are not wrong. They are incomplete. Frugality applied correctly is a superpower. Frugality applied incorrectly is a wealth-destroying virus. Think of a structural beam in a skyscraper. Remove the wrong one and the building stands. Remove the critical support column and the entire structure collapses. The Buffett doctrine does not say spend less. It says allocate capital with ruthless precision. Price is what you pay. Value is what you get. That is not a motivational quote. That is an engineering formula. Research into Berkshire Hathaway's 60-year compounding model reveals a recurring pattern. The highest returning decisions were never about spending less. They were about spending right. This is called the invisible architecture of wealth. And today, we are going to tear down the walls and show you the blueprint. Consider the Douglas DC-10 aircraft disaster of 1979. American Airlines Flight 191. 273 people on board. The airline had discovered a maintenance process that was 200 man-hours faster than Boeing's official protocol. So they used it. They saved time. They saved money. They removed one critical bolt incorrectly. The engine detached on takeoff. The plane rolled. It fell. All 273 people died. The cost saving was $2,000 per maintenance cycle. The cost of the error was $275 million in settlements and 273 lives. This is exactly what happens to retail investors every single day. Not with planes, with their own financial futures. They skip the professional advisor to save $500. They buy the cheap legal template to avoid a $3,000 attorney. They refuse to invest in their own skill development to avoid a $1,000 course. And then, silently, compoundingly, the engine falls off. The harder they try to save, the more catastrophically they lose. The Warren Buffett is unforgiving on this point. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Applied to your life, this means the wrong cheap decision does not cost you money once. It costs you money every single day, compounded invisibly for decades. Here is where it gets uncomfortable. The financial system is not neutral. It is engineered to extract maximum value from people who optimize for price over value. Consider this. The average American pays $1,300 per year in bank fees alone. That is $65,000 over 50 years before you factor in the opportunity cost of that capital invested in index funds at 10% annual return. That cheap checking account, it just cost you $800,000 in lifetime wealth. But that is only the first layer. Layer 2, the DIY legal trap. Small business owners who skip professional legal structuring lose an average of $50,000 in preventable tax liability over a decade, according to IRS data on sole proprietorships versus S-Corp. That is the exploitation layer. Here is the trap layer. Layer 3, and this is the brutal one, is psychological. When you are cheap in the wrong areas, you signal to your own subconscious that you are not worth the investment. You are not protecting your wealth. You are narrating your own smallness. And that story, that quiet, compounding inner monologue of "I cannot afford to invest in myself," becomes the most expensive thing you have ever owned. This is the scarcity compounding loop. You think small, you stay small, you prove yourself right, over and over again. Here is how we break the cycle. We are going to dismantle the architecture, one pillar at a time. Most people think health is a personal issue. They are wrong. It is a financial one. The Buffett doctrine uses one of its most vivid analogies here, one that analysts have called the one-engine framework. Imagine that a genie offers to give you the car of your dreams. But there is a catch. It is the only car you will ever get. How would you treat it? You would read the manual. You would fix every scratch immediately. You would never miss an oil change. Research into the Berkshire methodology reveals that Buffett applies this exact logic to human capital. Your body and mind are the only compounding vehicle you will ever have, and the data on neglecting this vehicle is staggering. A 2023 JAMA study found that individuals who invest in preventative health care spend 47% less on medical interventions over their lifetime compared to those who defer it. 47%. That is not a wellness statistic. That is a compounding formula. In human terms, the person who spends $200 per month on quality nutrition, sleep optimization, and preventative care is not spending $2,400 per year. They are buying back cognitive bandwidth, decision-making quality, and productive decades. The person who skips this? They eventually pay $15,000 in a single medical intervention, plus lose 6 months of income during recovery. The cheap decision cost 12 times more. So how do we break this loop? Treat your health care budget as a capital allocation decision, not a lifestyle expense. The specific threshold the Buffett principle suggests: allocate no less than 5% of your monthly income to physical and mental maintenance, nutrition, fitness, therapy, sleep, and preventative screenings. This is not vanity. This is asset preservation. It is not spending money on yourself. It is maintaining your most irreplaceable compounding engine. Now we enter the second pillar. This one stings a little more. I call this the intrinsic value moat. Most people think learning is expensive. They have never calculated the cost of not learning. A core tenet of the Berkshire methodology is what analysts call inch-wide, mile-deep expertise. Buffett himself has reportedly spent 80% of his career reading, not managing, not networking, but reading. The mechanism here is compounding returns on knowledge. McKinsey Global Institute data reveals that workers who invest in continuous skills development earn, on average, 42% more over a 20-year career than peers who plateau. That means a $1,000 investment in a high-leverage skill course, say financial modeling, copywriting, or coding, at age 25, produces conservatively $180,000 in additional lifetime earnings. That is an 18,000% ROI. No asset class in history has consistently matched this return profile. Yet, most people will spend $6 on a coffee without blinking, then agonize for 3 weeks over a $300 online course. That is not financial intelligence at all. The solution protocol: identify your single highest leverage skill, the one that, if doubled in proficiency, would double your income. Then invest in it aggressively. Set a minimum annual education budget of 3% of your gross income. This is not a cost. It is the highest returning capital allocation available to you. Knowledge compounds identically to interest. Being cheap on learning starves the compound effect at its root. The Buffett principle here is non-negotiable. The most important investment you can make is in yourself. Now we'll talk about the third pillar. This one shows up in your daily life, invisibly. I call this the wonderful company rule. If you have made it this far, you are not like most people. Hit the like button. It tells the algorithm this content is worth protecting. Subscribe so you never miss a breakdown like this one. Most people think buying cheap saves money. It does not. It multiplies cost. Research into Berkshire Hathaway's acquisition philosophy reveals a fundamental pivot that transformed the company's entire trajectory. Early in Buffett's career, he followed Benjamin Graham's cigar butt strategy, buying beaten-down, cheap companies with one last puff of value left. It worked until it didn't. The companies were cheap because they were deteriorating, and no matter how good the price, a deteriorating asset continues to deteriorate. Charlie Munger reoriented this framework with one insight. It is far better to pay a fair price for a wonderful asset than a wonderful price for a fair one. Applied to consumer behavior, every time you buy the cheapest version of a daily use tool, piece of software, or professional resource, you're buying a cigar butt. You're paying a friction tax. Every single day. Here is what that looks like in numbers. A $40 chair breaks in 18 months. Replacement cost over 10 years, $267, accounting for time cost of repurchasing. A $280 ergonomic chair lasts 12 years and reduces chronic back pain that costs the average knowledge worker $4,800 in lost productivity annually. The cheap option costs 22 times more over a decade. The solution, before any significant purchase, apply the total cost of ownership formula. PTCO equals purchase price plus annual maintenance cost times years of use, plus opportunity cost of friction. The number that matters is not the price tag. It is the TCO. And here is the part most people miss entirely. The opportunity cost of friction is invisible, which makes it the most dangerous variable in the equation. Every time a cheap tool breaks, every time a low-quality software crashes mid-project, every time an inferior resource slows your workflow by 20%, you are not just losing minutes. You are losing the compounding value of those minutes applied to your highest leverage work across the rest of your career. A 2022 Stanford productivity study found that knowledge workers lose an average of 2.1 hours per day to tool friction and system inefficiency. That is 546 hours per year. At a $100 effective hourly rate, that is $54,600 in destroyed value annually, often attributable to cheap infrastructure decisions. Analysts who study the Berkshire methodology call this the compounding friction effect. Small, daily inefficiencies that individually seem trivial but aggregate into career-defining wealth destruction. Buy wonderful, pay fair, stop buying cigar butts. Let's get into the fourth pillar. This is the one that quietly bleeds the most wealth. I call this the downside shield. Most people think professional advisors are for rich people. They are actually why people become rich. Berkshire Hathaway's rule number 1 is legendary. Never lose money. Rule number 2, never forget rule number 1. The wealthy do not protect their wealth with higher income. They protect it with superior legal and tax architecture. The IRS data is unambiguous on this point. The average sole proprietor, operating without a CPA or tax strategist, overpays federal tax by between $8,000 and $22,000 annually due to missed deductions, improper entity structuring, and inefficient retirement vehicle selection. Over 20 years, that is between $160,000 and $440,000 in preventable losses. This is the asymmetric risk equation. The upside of skipping professional counsel is saving $3,000 per year. The downside is losing $440,000 over a lifetime. That is a 1-to-147 risk ratio. No rational investor accepts those odds in any other domain. And yet, millions do it every year in their own financial lives. The solution: hire a CPA who specializes in your specific income type. Not a generalist, a specialist. Hire a business attorney to review any contract worth more than $5,000. The cost of elite professional counsel is not a fee. It is a premium on downside protection. And downside protection is the foundation of every great compounding story in history. Analysts call this the margin of safety applied to your personal finances. Now we enter the fifth loop. This one is about something no spreadsheet can fully quantify. I call this the 20-year moat. Most people think reputation is soft. It is actually the hardest currency in existence. The Buffett doctrine on reputation is one of the most cited principles in all of finance. It takes 20 years to build a reputation and 5 minutes to ruin it. But analysts who have studied the Berkshire model understand something deeper than the quote. Reputation is not a moral asset. It is a financial one. Trust lowers transaction costs. Research from Harvard Business Review found that high-trust companies outperform low-trust companies in total shareholder return by 286% over a decade. At the individual level, a professional with a reputation for absolute integrity commands premium pricing, attracts unsolicited high-value opportunities, and experiences zero cost of client acquisition. A professional who cuts corners on deliverables, reneges on small promises, or treats relationships transactionally, they spend 40% more on marketing, client retention, and damage control. Being cheap on your reputation, skimping on customer service, cutting corners to save time, breaking small promises to preserve cash is a compound interest machine working in reverse. The solution? Treat every commitment, regardless of size, as a reputational bond. When you deliver on a $50 promise with the same integrity as a $50,000 one, you are building what the Berkshire methodology calls the invisible economic moat. And moats, once built, generate wealth autonomously. There is a compounding dimension to this that most people never consider. Every time you keep a small promise, respond to that email, deliver that project one day early, follow up when you said you would, you are depositing into a reputational account that draws compound interest in the form of referrals, premium pricing power, and opportunity flow. The Buffett principle here is that trust is the lowest cost distribution channel ever discovered. When people trust you completely, they send you business without being asked, refer you without expecting anything in return, and choose you over competitors without comparing prices. That is not a soft benefit. That is a hard competitive moat worth more than any marketing budget you could deploy. Now we move to the sixth pillar. This one is about something most people confuse with productivity. I call this the capital allocator advantage. Most people think staying busy is the same as being productive. It is not. It is the enemy of it. Research into how Buffett structures his daily schedule is genuinely shocking for most people. He reportedly spends 80% of his working hours reading and thinking, not managing, not executing, thinking. The Berkshire model is built on a radical principle. Buffett is not an operator. He is a capital allocator. He sets the strategy. He deploys the resources. He empowers management. Then he gets out of the way. Applied to the average entrepreneur or professional, if you are handling tasks worth $15 per hour instead of delegating them to preserve $15, you are paying an opportunity cost that dwarfs the savings. Here is the math. If your highest leverage activity produces $200 per hour in value through client work, creative output, or strategic thinking, and you spend 10 hours per week on $15 per hour tasks, you are sacrificing $1,850 per week in net value. That is $96,200 per year in destroyed opportunity, to avoid spending $7,800 on delegation. The Buffett principle here is elegant and brutal. Time is the only truly non-renewable asset. Money can compound, skills can compound, relationships can compound. Time only depletes. The solution? Audit your weekly calendar. Identify every task you perform that you could delegate for less than your effective hourly rate. Delegate aggressively. Invest the reclaimed hours into your highest leverage thinking and output. This is not laziness. This is capital allocation applied to your most finite resource. Now we enter the seventh and final loop. This is the one most people feel, but cannot name. I call this the inner circle effect. Most people think networking is transactional. They are missing the entire architecture. The Buffett doctrine on relationships is perhaps the most underanalyzed component of the Berkshire model. Analysts who have studied Berkshire's deal flow over 60 years have noted a consistent pattern. The greatest acquisitions, Geico, See's Candies, Coca-Cola, American Express, were not sourced from cold databases or investment banking pitches. They came through trusted long-term relationships cultivated over decades. Research from MIT's Social Intelligence Lab found that 85% of high-value professional opportunities originate through existing relationship networks, not cold outreach. Yet the average professional is too price-sensitive to attend a $500 industry conference, too stingy to fly business class to a $5,000 mastermind, and too transactional to invest in relationships without an immediate visible return. The math on this is staggering. A $5,000 investment in a high-caliber professional environment, where you build genuine relationships with 5 industry leaders, has historically produced, in documented cases, partnerships and referrals worth $50,000 to $500,000 in value. That is a 1,000% to 10,000% ROI on what most people would call a pricey conference. The Buffett doctrine is precise on this. It is better to hang out with people better than you. Pick out associates whose behavior is better than yours, and you will drift in that direction. The solution: identify the 3 most important professional communities in your domain. Invest in access to them. Show up consistently. Add value first. Build without expectation. The inner circle effect does not produce immediate returns. It produces compounding asymmetric ones, and when the opportunity arrives, and it always does, the ROI will dwarf every saving you made by staying home. Before we go into the synthesis, if this breakdown has shifted how you see money, share this video with one person, not because we asked, because they need it. That is how elite knowledge spreads. We examined the one-engine principle. Your body and mind are your only compounding vehicle. Maintain them or pay exponentially. We exposed the intrinsic value moat. Knowledge compounds like interest. Starve it, and you starve everything downstream. We revealed the wonderful company rule. Cheap is not frugal. It is a hidden friction tax compounding against you daily. We decoded the downside shield. Professional counsel is not a fee. It is a margin of safety on your financial architecture. We unpacked the 20-year moat. Reputation is a financial asset that lowers every transaction cost you will ever face. We unlocked the capital allocator advantage. Time is non-renewable. Allocate it with the same precision Buffett applies to capital. And we revealed the inner circle effect. The highest returning investments are not in stocks. They are in relationships. These are not 7 tips. They are one unified system, the invisible architecture of elite wealth. Here is the final reframe. The gap between where you are and where you want to be is not as wide as it appears. You do not need more money to start building wealth correctly. You need to stop investing in the wrong cheap decisions and start allocating capital the way the world's greatest investor does, not by hoarding pennies, by engineering value. You already understand the Buffett principle. You always did. You just needed someone to show you the blueprint. Now you have it. The architecture is visible. The moat is buildable. The only question left is whether you will build it. Stop being cheap on the things that compound. Start being ruthless about where you allocate your greatest resources, your money, your time, your attention, and your integrity. The invisible architecture of wealth is not a secret reserved for billionaires. It has always been available. You just needed the blueprint. Now, go build something extraordinary. Subscribe for weekly Berkshire methodology breakdowns. Drop a comment. Which of the 7 pillars hit hardest for you? The algorithm rewards every comment, and so do we. See you in the next breakdown.